Before you skip around this video trying to find shortcuts, hold up. Because crypto isn't about catching the perfect pump or finding the secret altcoin that will 100x tomorrow. Crypto rewards the trader who understands the game better than everybody else. And the truth is, most people don't lose money in crypto because they're stupid. They lose because they don't know the rules. And when you don't know the rules, you get played. Played by the market, played by whales, played by hype influencers, played by your own emotions. So today, I'm giving you the complete beginner to profitable roadmap for crypto trading for free. No signal group, no affiliate links, no buy this token, none of that bullshit. This is the exact foundation that I wish somebody has handed me 7 years ago when I had $20 to my name, blew multiple accounts, and thought the problem was not enough indicators. So, if you want to actually learn how to trade crypto the right way and not become exit liquidity for someone else's pump, watch this video from beginning to the end. And by the time we are done, you will understand crypto at a level 95% of traders never reach. And make sure you stay to the end because I'm gonna give you a real 90-day plan to go from guessing and FOMO trading to becoming systematic, calm, confident, and consistent. And I'm also gonna give you a full free trading courses playlist so you can keep learning without spending a single dollar. You ready? Let's go. Brett, go. Let's go. Now, before you ask, yes, I'm just a guy in a hoodie talking about crypto. No, I'm not here to sell you a course. And no, my Asian mom still doesn't really understand what I do. And before you think, oh, here we go again, another YouTuber trying to sell hopium. Let me stop you because I don't need your money. I'm not launching a stupid meme coin. I just hate watching beginners get wrecked by meme coins and stupid influencers who trade screenshots rather than the charts. So let me show you why you can actually trust what you're about to learn. I've been trading for almost 7 years now. Not 7 months, not, oh, I caught this one bull run and now I'm a trading guru. 7 freaking years. Through brutal bear markets, drawdowns, self-doubts, and days where every freaking candlestick felt personal. This year alone, I've crossed over $1.5 million in trading profits, and I documented the entire journey publicly on my second channel, Bread Trade. And here's the part that actually matters. I'm not just profitable, I'm consistent. My win rate is around 65.4%, and my average risk to reward is 4.16R. And in simple English, that means for every dollar that I risk, I aim to make 4. So if I'm risking $10,000, that means I'm aiming to make back $41,000. That's not gambling. That's data, discipline, and repeatable edge. And most importantly, this is honestly what I'm the most proud of, is the fact that I've helped hundreds of students go from inconsistent and emotional to 6-figure funded traders in under 6 to 12 months. They didn't rely on hype, they didn't chase moon coins, they built skill, discipline, and a system. So if you want proof, student results, everything is all linked in the description. You can find my entire story in there. And once again, I'm not sharing this to flex. I'm sharing it so you know that this isn't theory. This is what I actually do every single day in the market with my hard-earned money on the line. So quite simply put, I don't want your money. I want you to trade better. Let's get into it. Look, in crypto, there's 2 types of people. You've got the talkers, the ones posting charts all day, predicting Bitcoin will get to 200K by Monday, and then disappearing when things crash. And then you have the doers. The people who actually put their hard-earned money on the line. Real capital, real execution, real consequences. I'm the second type. In the past 40 days, I've bought about $350,000 worth of Bitcoin and Ethereum. And on top of that, I've also got $100,000 invested in Coinbase stock. So once again, you can see, I have about $500,000 in crypto. And the reason why I do that is because if I'm gonna be talking about this market, I better be living in it, not watching outside the stadium. Now, bro, I'm not a crypto whale yet, okay? I'm just a baby whale, a sperm whale. Or, actually sperm whale is pretty big. Maybe like the sperm of a whale. Anyways, I'm not sponsored by any crypto exchange. I don't shoe coins. I don't pump garbage brokers for affiliate payouts, even though I've been offered a ridiculous amount of money to do so, like millions of dollars. But I treasure my peace of mind and my good night's sleep and integrity, so I'm never doing any of that stupid Jack Doherty shit, okay? Most influencers make money telling you what to buy. I make money by trading the market, not hyping it up or some BS. And just so we are clear, I'm not here to tell you the next moon coin. I'm here to make sure that you don't become exit liquidity. Because it's easy to make money once. The real game is keeping it, compounding it, and staying in the arena long enough so that you can actually see results, consistent results. And that's what I'm about. First of all, you must understand that crypto wasn't created so people could gamble on freaking dog coins or hope their portfolio goes 10x overnight. It wasn't built for hype. It wasn't built for Twitter. It was built because the current financial system is broken. It's slow and is controlled by a few. Let me explain. Today, your money is basically an IOU from a bank. If the bank shuts down, freezes your account, or decides that you violated some policy, you're stuck. So you don't actually own your money. Yes, you have access to it as long as the system lets you. With crypto, it flips that. With crypto, you actually own your value directly. No banks can pause your funds. No government can print more and dilute your savings. Bitcoin is limited. There's only like a limited supply of Bitcoin. And you don't need permission to move your money, trade, invest, or build wealth. That's the first thing that crypto solves, which is ownership and freedom. Right? So in crypto, your wallet is literally your bank. Secondly is borderless finance, access and fairness. Traditional finance says, oh, you need paperwork, you need approval, you need minimum balances, you need to trust a bank. Crypto says, if you have a wallet and an internet connection, you are in. It doesn't care who you are, where you are from, what your credit score is, what is your skin color, or if a bank likes you. As long as you have wallet and an internet connection, you can exchange. You can provide value. You can exchange value. Next, it's all about transparency and trust. In banks, everything happens behind closed doors. In crypto, every transaction lives on the chain, which I'm going to explain what that means later on, which means that every transaction is publicly verifiable. So you don't have to trust anyone's word for it. You trust math and code, which cannot be fake, cannot be broken. And that leads to the most important idea on this slide. Crypto is the transition from banks controlling value to code controlling value. We are moving from a world where we rely on middlemen like banks, governments, and payment systems, payment processors, to moving money to a world where value flows freely through transparent protocols and smart contracts. Smart contracts are essentially like the financial agreements that execute automatically. There is no human being involved, no approval, no delay, not just pure logic. So I hope that I've proved to you that this is not just some internet money. This is literally a new financial system being built in real time. 20 years ago, the internet changed communication. Now, crypto and blockchain technology is changing ownership, finance, and trust. And this is why this matters. And this is why you need to start taking it seriously. And if you don't understand this, whatever I just shared with you, this is the foundation, then later on when I share with you the charts, the entries, the setups, none of it will click. So we are not here to chase hype. We are here to understand a paradigm shift and then trade it with discipline. Now that you understand why crypto matters, let's break down what crypto actually is in the simplest way possible. In just one sentence. Crypto is basically digital money and digital ownership. But instead of being secured by a bank or a government, it's secured by cryptography and code. And the technology behind this beautiful phenomenon is called blockchain. A blockchain is literally a public database. It's like a digital record book where every single transaction is stored permanently. And the key thing here is once a transaction is recorded on the blockchain, it cannot be changed. Nobody can go back and delete or edit history. Not a bank, not a government, not a developer, not even the founder of the blockchain itself. And that's what ensures trust. Once again, not people, not institutions, but math and code. And unlike traditional finance, you don't need permission to use it. You don't need a bank account. You don't need paperwork. If you have internet, you can interact with crypto. And here's a simple way to visualize it. Imagine a Google Sheet shared publicly with the entire world. You probably know what's Google Sheet if you work a 9 to 5. And I want you to think of it like that, right? It is essentially just a publicly shared Google Sheet, but nobody can change past entries and only the network's rules decide what can be updated. That's the foundation behind crypto. It's basically an open, transparent finance secured by cryptography, not institutions. Now, before we dive into each category of crypto assets, I want to show you the entire crypto universe at a glance. And a lot of beginners, they see a sea of logos and think everything is the same. It's not. Every token sits in a different part of the ecosystem. And on the left-hand side, what you have right here is the core assets. Bitcoin, Ethereum, the base blockchains, the scaling layers, and the stablecoins. These are the foundation, the infrastructure, the blue chips. And then in the middle, you have the functional tokens. These are the coins that run the entire decentralized finance, infrastructure, exchanges, and payment systems. These are the working tokens behind the scenes. And then on the right side, you got speculative assets, right? These are the gaming tokens, the AI tokens, the privacy coins, and of course the stupid meme coins. These can pump incredibly fast, but they can also disappear from the face of Earth. And once you really understand this map, the market starts looking random. You start to recognize patterns. You stop gambling and you start allocating with purpose. Now, if you have no idea what the hell I just said, don't worry. Let's break each section down in simple English so it clicks for you. The first thing is the called crypto assets. When people come into crypto, they immediately jump into random coins. And that is how beginners get wrecked. If you want to start here. This is pretty much the foundation layers of the entire crypto ecosystem. So first of all, we got Bitcoin and Ethereum, right? These are the blue chip assets. Think of Bitcoin as digital gold. It's pretty much like a store of value. And then think of Ethereum like a global computer. It's pretty much the foundation where apps are built on. And then you have layer 1 blockchain like Solana and Avalanche. These are like competing operating systems, just like iOS versus Android. Next, we have layer 2s, which is Arbitrum, Optimism, Base, and Polygon. Now, imagine the main highway, which is Ethereum, is getting crowded. Layer 2s are essentially like the fast express lanes that is built on top to handle more traffic cheaply. And of course, we got the stablecoins, which is USDT, USDC. These are pretty much digital dollars you can use to trade and store value without any volatility. These are pegged against the US dollar. But once again, remember, stable doesn't mean zero risk. This category that you can see over here, these are the backbone of crypto. And if you don't understand any of this, you shouldn't even be thinking about trading meme coins. Now that we have covered the foundations, let's talk about the function-driven categories, the functional assets, the tokens that actually power real systems. Firstly, we got the DeFi tokens. DeFi basically means decentralized finance, okay? So DeFi tokens like Uniswap and Aave, they are pretty much tokens that lets you trade, lend, and borrow without needing a bank or a broker. It's basically Wall Street rebuilt on code. And then we got the infrastructure tokens, which are like the plumbing. Chainlink gives the price data to the blockchain. So think of it like internet cables and data feeds behind the scenes. And then Cosmos and Polkadot help blockchains talk to each other, while Filecoin stores data, and all of this stuff is like not really sexy, but it's essential for like the entire system to work. And then you got the exchange tokens like the Binance coin thing. These are basically loyalty points with power-ups. Hold the token, you will get lower trading fees and you will access certain features. And it's quite similar to airline miles, but for trading platforms. And then last but not least, you got the payment networks like XRP and XLM. Their job isn't to make you rich overnight. Their job is to move money fast and frictionless. So these are essentially like the modern versions of Swift transfer and Visa rails. So once again, this entire category exists to run the crypto economy, not just speculate on it. Alright, now we move into the wild west of crypto. These categories attract the most attention on social media. And realistically, this is also where most beginners lose their money. Gaming and metaverse tokens. These are the tokens that bring digital economies to life. Cool vision, but most of these rise and fall with hype cycles. And then you got the AI tokens. This exploded because AI is currently hot right now. It's like the trending topic, right? So for AI tokens, some will survive, some will die, because it's heavily narrative driven and it's not proven long-term economics yet. And then we got privacy coins like Monero, which exists for one purpose: financial privacy. It's a useful piece of technology, but they attract regulatory eyes. And then last but not least, we got the meme coins. And let's be real, meme coins, it's pretty much the internet cultural casino. They move on memes, viral energy, social momentum TikToks. not on fundamentals. Can you make money with them? Yes. You can make a lot of money very, very fast. Can you lose everything? Also, yes. Faster. So the rule here is simple. You want to build your foundation with serious assets like Bitcoin, Ethereum, and like what we have just shared in the first category. And you only want to speculate on what you're willing to lose. You know, like 10% of your capital, put it into these crypto assets and hope that they can 100x in next year, right? Hope that Shiba Inu can go from 1 cent to like $10 or some BS like this, okay? But only speculate with the money you can afford to lose. If you need that money for rent, you need the money to put food on the table, do not speculate with that money, please. Now let's talk about one of the biggest unlocks in crypto. Understanding where money actually moves. Because crypto isn't just charts, it's pipes, like water systems. So when a transaction happens on-chain, it means that it's recorded publicly on the blockchain, which also means that anyone can see it. Like you can literally watch whales move trillions of dollars, millions of dollars. You can also see funds rotate into ecosystems, retail buying tops, smart money accumulating bottoms. So it's transparent, it's permanent, and it's undeniable. If someone moved $50 million into Ethereum or Solana, you see it. Okay, there is no such thing as, trust me bro, I bought 100k of crypto. No, you can actually see the entire transaction on blockchain. So it's essentially like water flowing through a clear glass pipe. You can see everything inside. And then you got off-chain. Now, off-chain is when you trade inside a centralized exchange like Binance or Coinbase. Your balance is basically an IOU from the exchange, just like a bank account is an IOU from the bank. The exchange isn't broadcasting your trade to the blockchain. They're just updating numbers in the private database. So that's like water flowing through a steel pipe. You can't see what's going on inside, and you're trusting the exchange to handle it correctly. And we have seen what happens when people trust blindly. Like just look at FTX, Celsius, BlockFi. Those are infamous bad cryptocurrencies exchange. So off-chain is convenient, but it comes with trust risk. And the reason why this matters is because, like I said earlier, crypto has given us a superpower right now that traditional finance never had. Like right now, we can actually see where the money is going on in real time. Most beginners, they only watch price. Professionals watch order flow. Price move after big money move. So if you learn how to track on-chain activity, you stop buying tops, you start spotting real accumulation, you avoid exit liquidity movements, and you start thinking like institutions rather than like retail. And this is how you get ahead of the crowd. So on-chain is basically truth, off-chain is trust, and as you progress, your job is to move from trading charts to reading the blockchain like a map of money movement. And that's how you stop guessing and you start positioning with intention. Now let's simplify how price move in crypto so you never feel confused watching a chart ever again. First of all, you must understand that price is essentially a seesaw. If there are more buyers than sellers, price goes up. If there are more sellers than buyers, price goes down. As simple as that. But crypto isn't a calm playground seesaw. It's a seesaw strapped to a rocket engine because there's a lot of buyers and sellers every single day playing this tug of war, right? At any point of time, price can go from up, down, meaning there's a lot of volatility, a lot of liquidity in the market. So if you're not careful, you're gonna get effed. Which is why the first concept you must understand is supply and demand. Every candlestick you see on the chart is essentially just a battle between buyers and sellers. Buyers create demand, sellers create supply. When demand overpowers supply, you get green candles. When supply overpowers demand, you get red candles. Okay, simple. That's it. Green candles means bulls are in control. Red candles means bears are in control. And this is the foundation of all the financial markets. Next, we got liquidity pools. And here's where it gets interesting. There are essentially pools of liquidity sitting above and below price in the form of stop losses, liquidation points, leverage positions. And smart players, they know exactly where those levels are, while retail doesn't. So sometimes price doesn't move because of news, because Elon tweeted this. No, it moved to hunt liquidity, to fill orders that is sitting at the key levels. And then we got the market makers. A lot of retail traders think that price is random. Professionals understand that someone is always on the other side of your trade. Market makers, they provide liquidity, they balance order books, and they take the opposite side when needed. And they also push price into liquidity zones like what we have seen just now, right? They pretty much manipulate price, or rather not really manipulate price, but cause price to move in a way where it actually benefit them. Now, their job isn't to beat you. It's not to like purposely harm your stop loss. Their job is to make the markets efficient. But if you act emotionally and you chase price, these guys will happily take your money. And then we got leverage. And this is why crypto gets crazy. Leverage is essentially a double-edged sword. It can allow you to make a lot of money fast, but it can also allow you to lose a lot of money fast. And this is basically when people borrow their money to trade. When people borrow money to trade, their positions can liquidate, which means close by itself if price move against them. And liquidation creates forced buying or selling, turning this seesaw phenomenon that we have explained just now into a roller coaster. And this is exactly why crypto dumps and pumps sharper than stocks. It's not magic, it's just leverage unwinding. So quite simply put, price isn't random. It's supply, demand, liquidity, and leverage interacting at speed. And I always say this, markets evolve, human nature doesn't. Market conditions might change, but human emotions don't. So the game might change, the rules of the game might change, the players might change, but one thing that will never ever change is human nature, which is why these principles have stood the test of time and they are going to continue playing out over the next 50 to 100 years, as long as there is humans. And once you stop reacting emotionally and you start thinking in market mechanics, you begin to trade like a professional. Now, crypto doesn't move randomly. It moves in cycles, just like every other market in history, whether that's commodities or stocks. And there's this quote by Mark Twain which says that history doesn't always repeat itself, but it sure rhymes. Which means that it's all about spotting patterns in the market. It's about identifying what cycle the market is in right now so you can take the best course of action. And every crypto cycle has the same 4 stages. So if you learn to recognize them, you stop guessing and you start positioning yourself like a professional so you can benefit from the next stage, the next phase. First of all, we got to build up, which is the boring phase. Okay, this is the quiet part. Nobody cares about crypto. Twitter is silent. YouTube views are dead. Search volume dies. Everybody says crypto is dead. Crypto is a scam. And this is where smart money just accumulating quietly. They're just buying, just loading up. And the people who win this game, they don't wait for hype. They buy bottom. So this is the phase where they are entering into the market. And then next we got the breakout. This is where smart money starts pushing price out. This is where it starts to see this huge momentum. Price break out of this long consolidation, volume increases, narratives start forming, Bitcoin is going to get to $1 million. And then this is where smart money that have accumulated somewhere around here, they start to mark the price up even higher. Retail notices this, but they still down, right? So this is where they are like, this is cool. But maybe crypto isn't dead, but I'm still not sure whether to get in or not, like I still don't really understand it. And then next you got the euphoria stage. This is the phase where everybody thinks that they're Warren Buffett. The barista at Starbucks starts giving you investment advice instead of asking for your name on the cup. Your cousin makes a meme coin trading course. People quit their 9-to-5 jobs to become full-time crypto traders. And then you see TikTok has like a lot of overnight crypto millionaires. And this is where everybody starts buying the top, right? And they think that, oh, you know what, this is just the start, man. Like this is the bottom. We are going to continue going up to $1 million. If you feel this fear of missing out everywhere, you're not early, you're late. And then we got a crash. This is where reality hits. Exchange start blowing up, funds get liquidated, retail traders get stopped out because they have over leverage, tokens drop 70 to 90%. And everybody start deleting their profile picture with the laser eyes and like their tweets on #diamond_hands. And this is where people who have conviction in crypto, they stay in the market. While the people who are just looking around like tourists, they disappear. And then the whole cycle restart again. So institutions start building up again where everybody is gone out of the market, out of liquidated. And then they start marking price up, cause price to break out, and then now everybody starts getting euphoria again. And the same thing over and over again. And this has happened for like the past 10 years. So the general rule of thumb is this. Buy when it's boring. Sell when normies are bragging. If your barber is asking you about altcoins, it's probably not adoption stage. It's exit liquidity season. Now just look at this. This is Bitcoin price. And this is Google search interest for the term Bitcoin. Like, it's diabolical. It looks exactly the same. When nobody's searching for it, nobody's talking about it, it feels boring and it's dead. And this is where smart money buys. And then when suddenly everybody becomes a crypto expert, when searches explode, this is where the world wakes up. This is usually where price is going to start crashing any point of time right now. Because remember, crypto follows attention and money flows where attention goes. So do not chase price. Pay attention to silence. That's where the opportunity hides. Most beginners lose money not because of their strategy, but because they pick coins randomly. Like they trade every single Tom, Dick, Harry coin that they can see online or whatever, like everybody's talking about Reddit. And that's not how professionals does it. Because trading isn't about hype. It's about liquidity, structure, and momentum. And here's how I think about it. First things first, trade the majors. You're much better off just sticking with Bitcoin and Ethereum. These move very, very clean. They respect levels, they respect price action, and they don't wick like crazy. And if you can't trade these well, then you shouldn't even be like worrying about the other stuff. And then once you get proficient at Bitcoin and Ethereum, this is where you can perhaps start moving into strong trending coins like Solana, Avalanche, and major layer 1s and layer 2 coins. Once again, these are the narrative leaders. If Bitcoin is the market engine, these are the sports cars that move harder in trends because they all follow Bitcoin. And only then, once you are done, then you can start looking at narrative plays like the AI coins, infrastructure tokens, like coins that is heavily based on where attention flows. And you should only look at this stuff when there is momentum, when it's trending, when there is volume. Because momentum plus liquidity equal opportunity. Narrative without liquidity equal trap. And then last but not least, we got the speculative plays like the meme coins, the micros, this is essentially like the penny stocks in the stock market. You don't really trade this all the time. You trade them during very specific moments. When volume explodes, when there is real liquidity, real demand. Because if you try to trade meme coins during slow period, like I said, you're just going to end up being the exit liquidity. So my point here is that you don't start by trading meme coins. You earn the right to trade riskier assets, not the other way around. So start in this particular order. Start with the majors, then go to the high liquidity leaders if you want, then the narrative leaders, and then, like I said, if you want to trade the speculative plays, put a very, very small portion of your capital into it, right? Maybe 10% or less than that. Now, before we continue, I need you to understand something. Investing builds wealth slowly. Trading accelerates wealth if you have discipline. And confusing the two is how people blow up accounts. This video is about trading. Okay, it's not really about investing. It's definitely not about backholding meme coins and calling it long-term conviction. Buddy, chill. You're not Warren Buffett, okay? Cool? Gucci? Cool. Now, when you pick coins to trade, there are two layers of thinking. Fundamentals keep you safe, but momentum gets you paid. So let's start off with fundamentals. And don't get it twisted. I'm not saying we become long-term investors. But if you pick trash, you get trash outcome. Crypto rewards hype, but it also brutally punishes ignorance. So fundamentals allow you to filter out all the garbage, or like the shit coins first. So these are the list of questions you have to ask yourself to ensure that, this coin actually has sufficient liquidity and is actually worth trading. The first thing is there like a real use case? Is this solving a real problem? Or is it just a fancy website and a pipe dream? If there's no reason for the token to exist, skip it. Speculation without utility eventually dies, right? Without hype, without volatility, without attention, that coin is just gonna fade away. Next thing you wanna ask yourself is there a strong team behind it? Now, once again, you don't need to worship founders, you don't need the next Vitalik Buterin, but you do need to check if they're legit. Have they shipped before? Do they disappear and run away with your hard-earned money in bear markets? Do they pump and dump, In crypto, founders who vanish equate to your money vanishes too. So a good example of like a strong team is look at the Sui coin that came out recently. Not recently, but like a few years ago. SUI, right? That coin is pretty much backed by Meta employees or ex-Meta employees, right? So you can see that there's a strong team behind it and it actually has like a real use case as well. Next is on-chain activity. Now, you always want to make sure that you follow wallet and users, the order flow, institutional flow of money, rather than marketing. If usage is increasing, liquidity flows behind it. And if nobody's using it, then you're just gambling, bro. Next is volume. Volume to me is like oxygen. Without it, you're stuck in a position begging someone to take your bags. High volume means you can get in and out without sleeping like a clown, right? High volume means high liquidity. It's the same thing with real estate. Real estate, low volume, low liquidity. It can take months to actually sell off the house. But with crypto, if there is sufficient volume, there's a lot of liquidity in the market, right? It's fairly liquid, then you can easily find a buyer to fulfill your sell order, right? So once again, high volume equal high liquidity means you can get in and out fast. Not just hype. This is probably like the most important question right here. If the only reason the coin is pumping is because of, I don't know, freaking TikTok or like stupid influencers, be careful. Because narrative alone can send coins flying, right? All the fanboys start buying the coin of that particular trading influencer. But when the hype dies down, which it inevitably will, it crashes twice as fast. So you always want to make sure that you are buying, or rather you are trading a coin that actually fulfill all of these criteria right here. The more criteria you actually checked off from like this list right here, the stronger the coin is, and the more likely it's not going to go to shit, and the more likely you can trade it safely. So the bottom line here is fundamentals do not make you rich, but they sure as hell stop you from blowing up. And that's all you need. Next, we got technicals. If fundamentals keep you safe, then technicals decide if you enter, when you strike, when you buy, when you sell. So once a coin passes a fundamentals test, right, you pretty much answer all of these questions right here. Now we can trade like killers. Then now we can ask ourselves the next list of questions about technicals. Number one, is it trending? Always remember, trend is king. If it's moving strong and clean, ride it. If it's chopping, going sideways, there's not much opportunity in the market, there is no clear trend direction, leave it. Because I've learned it the hard way, but choppy markets kill more accounts than like bad entries do, right? So it's not worth it. And this is especially true for crypto as well. Like when crypto trends, it trends really, really fast and long. So you might as well ride the momentum. Next is there clear liquidity? Once again, we are not here to trade stupid coins which doesn't exist. We don't trade ghosts. If there is not enough liquidity in the market, your entries and exits will get wrecked. All right, like you won't find sufficient sell orders to fulfill your buy orders. You will get in and out too late, or even get in at bad prices because there is insufficient liquidity, right? And then you have to suffer the cost of like bad spread and pay more commission and fees. That is really quite unnecessary. Because remember, smart traders, they serve wave, not powders. Next is volatility tradable, not random? Some coins, they move quite clean. And some other coins move like freaking crackheads. We want structured price movement. We want assets which follow price action, not chaos, not randomness. So volatility to a certain extent is good, as long as it's controlled and it's readable. And then next, you want to ask yourself, is Bitcoin supportive? I want you to view the entire crypto universe or the entire ecosystem as like the solar system. Bitcoin is essentially the sun. Altcoins are essentially planets, which also means that if Bitcoin dumps, the whole solar system crashes. Everything else is following Bitcoin. So never fight the king. Always check the Bitcoin first. And last but not least, ask yourself, is the narrative hot right now? Because crypto moves in story circuits. Unlike traditional stocks, right, where there is a certain intrinsic value attached to a company, crypto moves based on sentiment, based on how the market feels about that particular coin itself. If there's hype, there's a lot of attention going into it. Like I said, that's where the money is going to flow to it, including institutional money. So example, like right now AI is trending. Then if that's the case, then you can expect a large amount of institutional volume or even retail volume going into the AI tokens. And then maybe in the future, we got metaverse tokens popping off because of the fact that, everybody start adopting metaverse, right? So whatever is trending, whatever have like this awesome story behind it, that is where money is usually going to flow into. So if you trade the right crypto at the wrong time, you lose. Point blank period. So in Wall Street, we have this adage called, if you are early, it's just the same as being wrong. Like being early is just the same as being wrong, right? So you always want to make sure that you are getting in at the right time, at the right place, at the right price. And if you catch the right narrative early, then my friend, you're going to print. So my point here is that we don't predict narrative. We recognize them early and we position ourselves fast, ideally before the institutional flow of money. Basically, fundamentals keep you from being the exit liquidity, while technicals, narrative, volume give you the rocket fuel that price needs to actually 10x or 100x. So you always want to make sure that you trade from a position of strength rather than blind dreams. Now, before you place a single trade, you need your foundation set up properly. Crypto is like entering a jungle. You don't walk in shirtless with a butter knife. No, you're gonna get effed by saber-toothed tigers. No, not saber-toothed tigers. Those are already extinct. But you're gonna be effed by, I don't know, tribesmen or like weird insects and animals, So make sure you gear up first. Step 1, create a trusted exchange account. Most people start with Binance or Coinbase, like these are the two most popular crypto exchange account, right? And these are like the most trustworthy ones as well right now. So you might as well just go with either one of these. To me, I prefer Coinbase, and I think Coinbase is much more beginner friendly, but Binance has a few more features, right? Depending on the region. So just make sure that no matter what crypto exchange account you choose one that is trusted and is regulated. And it's not some exchange that is promoted by your favorite trading guru or it only exists on Telegram, right? Like that's obviously a scam. So just find one that is trusted, regulated, safe, because that's where you're going to be parking hard-earned money. Next is set up a secure wallet. Once again, to me, this part is non-negotiable. You do not want to keep your long-term crypto inside exchanges. Yes, Binance and Coinbase, super safe. I personally would trust my money with them rather than any other brokers out there. But remember FTX, right? Like that pretty much proved to us that any point of time, a crypto exchange can potentially fall, and just like it's very hard for you to actually recoup your hard-earned money from it. So yeah, once you're ready, just get a cold wallet like a ledger, like a physical ledger, just like what you can see on the screen right now. That's pretty much your digital safe. Okay, so next is transfer funds correctly. Always make sure you test with a small amount first. Okay, like for me, when I first started opening an account with Coinbase or Binance, I started with $100. Just deposit $100, even though I have like millions in the bank. The reason is because of the fact that I want to test the platform. Okay, so just make sure you test with a small account first, right? Like maybe $50, $10, whatever. And just ensure that you always double check the figure that you are depositing into your account. Now, this not only applies for when you deposit money into your own trading account, but it also applies when you transfer your money, your crypto, into another person's account. Because crypto does not forgive typos. If the chain is wrong, funds is going to be wrong. If your address is wrong, funds is going to be gone. Right? So make sure you double check everything, double check every single detail, and just move very slow right here. Right? Even professionals who are like transferring $1,000, they always triple check. And the final step is to start with spot trading first. Leverage looks sexy. 50x leverage, 125x leverage. Oh my God, I can become a millionaire overnight. It looks sexy until it punches your account in the face. Like, I think that's what Mike Tyson said, right? Like, everybody has a plan until it punches you in the face. Everybody wants to go 10x leverage. But if you can't grow $1,000 without leverage, you're not ready to trade with leverage. Trade with your own capital. Learn how to manage risk. Earn the right to scale. Earn the right to use leverage. And also here's like a quick little pro tip. You can make money and still lose it if you don't protect your keys. So make sure you always protect your keys. Have a ledger, right? Ensure that you are double checking when it comes to transferring your funds. And I just want to say that, honestly, crypto doesn't just reward skill. It punishes carelessness. Like you can be profitable and still wipe out your account by being sloppy with your security. So please, get a ledger, keep your crypto safe, and don't let your ego make money and let your laziness lose it. Gucci, let's rock and roll. Now let me quickly walk you through how to trade crypto from start to end, A to Z on Coinbase platform. Alright, so let me just quickly walk you through the entire Coinbase platform, so you know exactly how to invest on there, how to trade, and what every single one of these buttons actually means and what they actually do, instead of clicking around like a stupid confused hamster, So first things first, when you go to Coinbase.com, go and create an account, right? They will probably require some legal details from you, like your name, your identification document, so on and so forth. Once you've created your account, this is what you will see, all right? This is the home screen. On the right-hand side, this is where you get to buy, sell, or convert cryptocurrency. So buy, very simple. You want to buy Bitcoin, or you want to buy however much of like whatever crypto you want to buy, you can just buy it right here. And you can choose to buy like literally anything, right? Tether, XRP, Solana, Dogecoin, whatever you want to buy, you can buy it over here. Cool. Now, if you want to sell, this is where you sell, all right? And then if you want to convert a specific cryptocurrency to another sort of currency, like converting crypto to Bitcoin, you can just do something like this. No, please do not do that. But yeah, you can just convert whatever cryptocurrency that you currently own to another cryptocurrency, right? So it will sell off this particular currency and it will buy this other currency. All right, so quite simple. Buy, sell, convert. Send crypto, this is where you can send to another person, right? I shouldn't be showing that, right? But yeah, this is where you can send crypto to another person. And then this is where you can receive crypto, right? So if you want to send me crypto, I can give you my wallet address right here and then you can send it to me. And then this is where you can deposit your money over here via, a few methods right here, bank transfer, so on and so forth. And then if you want to withdraw the cash that you have in this particular account, just press this button right here. Okay, so this right here is quite self-explanatory. You can also set up like a recurring buy order. So if you are someone who want to invest, you want to like dollar cost average into Bitcoin, set aside like 5K a month to put into it, this is where you can set up like a recurring daily, weekly, or bi-weekly or monthly purchases. All right, so this is where you pretty much buy, sell, convert Bitcoin. This is like the simple platform. This is not really for you to trade, okay? For you to trade, you want to be using the advanced platform. All right, before I go to the advanced platform, right, once again, just to show you like the remaining cool features is you can add your favorite currencies, your favorite cryptocurrencies over here onto your watch list itself. And then you can see all your assets in here. You can see this is how much Bitcoin and Ethereum that I currently own right now. It's fluctuating, going a little bit crazy right now. The market is getting a little bit hot right now. So yeah, we're kind of down right now, but it's okay. And then this is where you can see all the transactions, which I'm not going to show you because those are like kind of private. And then this is where you can explore like, the different cryptocurrencies. You can see the top gain, the top losers, so on and so forth. Very, very cool. Okay, and then you can see a derivative right here. I'm going to go through this in a bit. And then Coinbase One, this is like the additional subscription, which I'm not really go through. All right, so when you press this button, you will go to Coinbase Advanced mode. And this is where you're going to spend majority of your time if you are trading crypto on Coinbase itself. The first thing you must understand is that over here, this is really where we do like the intense trading. We can see the candlestick charts, we can see the order book, we can place our buy and sell orders. The basic mode, it's not really ideal for trading. It's more for like investing, more for like buying assets, right? But if you're actively trading, you want to see every single move in price, click on this button right here and go to the advanced mode. All right, and on the left hand side, you can see there is spot, derivative, orders, portfolio, and referral. Right, these are basically like different rooms of the house itself. Spot trading is basically you are trading your asset. So if you trade spot, you actually own the asset itself. You are trading your own Bitcoin. Derivative, on the other hand, or what is also known as perpetuous, this is where you are just simply trading the price movement of the asset with leverage. Okay, so that's the main difference. Like I said, majority of traders out there, if you're a beginner, you don't want to be over leveraging, you don't want to be risking money, can't afford to lose, you're much more better off just trading whatever you have. Like start a small account and just spot trading crypto. All right, simple, Gucci. And in the middle, this is our chart. This is pretty much your battlefield. You can just press this button to like go full screen. But this is where it's similar to trading view. So once again, I'm gonna go through too in-depth into this, but you got your time frames over here, you got your indicators where you can slap on whatever indicators that you want. You got the SMA, EMA, volume, RSI, Bermuda Triangle, indicator, whatever you want. You can just slap on the indicator in here. And on the left-hand side, you got all the tools right here that allow you to actually mark up the charts. You want to mark up your retail and support and resistance level, or like you want to draw like a box right here to indicate that this is actually like a consolidation. You can just do so like over here. All right. So these are all the tools. Like I said, it's pretty much just like TradingView. So I'm not really gonna go too deep into this. And if you want to trade clean, you want to mark up your charts very, very clean, just like how I do it. This is where you're going to be relying on these tools right here, right? The trend line tools, so on and so forth, the line tools. So above this chart itself, you can see right here, this is where the interesting stuff happens, all right? So for spot trading, last price, 24-hour volume, 24-hour high, low, this is pretty self-explanatory, so I'm not going to go into that. But I want to go through with you the prices that you see on top when you are looking at like the perpetual, the derivative prices, because this can get a little bit confusing, okay? So let's go from left to right. So the last price, this is the current traded price, okay? Pretty straightforward. This is the price of Bitcoin right now. And that's the price that it's trading at. So if you want to buy and sell, you're going to be trading at this particular price itself. And then next we got mark price. This is the one that matters the most. This is what your liquidation is calculated from, not the last traded price. So if your mark price takes your stop loss or your liquidation line, you're done. Even if the chart wick doesn't actually like physically touch into it. So watch your mark price, okay? Very, very important. Professionals watch the mark price, while beginners watch candlesticks and just pray for the best. Next, we got the index price. Index price, this is the fair value that is put from multiple major exchanges. It stops the price from going crazy if one exchange randomly wicks, right? So this is treated as like the market price across like different crypto exchanges. Next, we got your funding rate. The funding rate, once again, this is where it could get a little bit confusing, but this shows whether longs are paying shorts or shorts are paying longs. If the funding is actually positive, like what it is right now, longs pay. If it's negative, then shorts pay. Once again, this is useful because it helps you understand the market bias and the market sentiment. Next, we got the open interest. This is the total open future positions. When open interest climbs up, this means that money is flowing in, right? Volatility is on the way, right? So this pretty much means that a lot of institutions, a lot of traders, there's a lot of trading volume right now, right? Once again, the total open future positions, like basically what you can see right here. And then we got the volume, all right? So volume, this tells you how much is trading right now. High volume confirms that, there's a lot of crazy move in the market right now. Low volume assumes that the market is either half asleep or it's just dead right now, and you're much better off just waiting, right? Rather than trading a market that is quite quiet. Okay, so once again, this allows you to keep track of like the daily trading volume. And then you got your 24-hour high and 24-hour low. Once again, this is the highest price that price has reached to within the past 24 hours. Same thing as this one right here. Instead, it's just the lowest price. Okay, so that's pretty much what all these like random numbers that you can see up here actually means. Simple, Gucci. All right, so if you press this button right here, this is where you can choose like whatever you want to be trading. Right, you want to be trading Solana, Ethereum, XRP, Doge, whatever it is, you can trade it right here. All right, same thing, right? Same thing as spot, right? I'm just gonna go through everything on like the derivative platform because this is where a lot of traders is gonna be on, since a lot of people watching this is gonna be using leverage. All right, so those are the prices on top, and that is the price chart. And over here, this is the depth chart. This once again allow you to kind of see like the depth of markets, which basically means like the amount of buy and sell orders in the market right now. This is pretty much synonymous with like the order book that we have on the right hand side right here. All right, so if you look at the order book over here, what does this actually means? This waterfall of like red and green that you can see right now that is like constantly updating every single second. This is what we call the order book. And it shows the bid and ask in real time, right? So you can literally see the exchange between the sellers and the buyers. You can see all the recent trades that is coming through, right? You can see all of this. It's updating every single second. It's because people are actually placing this trade actively, right? And yeah, you can see this is crazy, right? You can actually see the order, the volume right here. And then this is where you got the trade history. Okay, so over here, you can literally see like what are the orders that have been placed for the past few seconds, the past few minutes itself. And if you want to like lower like the frequency of like this thing updating, you can just press this button right here, by the way, right? So this is really, really useful. So once again, you don't really need to like stare at these 24/7, but it's good to just kind of glance to see like the exchange between buyers and sellers to see who's in control of price. Okay, so yeah, you can see right here, very, very simple. And then on the right hand side, this is where you actually place an order. This is where you actually buy or sell, or you place a limit order and wait for price to get there. And then your exchange will actually execute the trade at that particular price itself. The first thing you can see right here on top of the screen is this button right here. And this is where you get to choose cross or isolated. Cross is basically where you are using your whole balance as the margin. You're using your whole, the total balance as the margin itself. And isolated keeps each position separate. Once again, for most beginners out there, you're much better off just using isolated. Or if you are entering for this trade and you're planning to hold it overnight, use isolated, right? Because once again, it literally means that you're isolating the position rather than betting your entire account on that trade itself. And then below here, or rather below here, before we go to the below here, you can see on the right hand side over here, this is where you get to change your leverage. This is where you can choose 1x leverage, 3x leverage, 5x leverage, 20x, 50x, whatever it is, right? And you can get, at most goes up to 50x, right? Which is freaking a lot, okay? So yeah, for beginners, just stick to 2x or 1x or 3x, right? Like I said, you're much better off just ensuring that you know what you're doing to protect your downside and you don't actually get liquidated. So that's leverage. Next, this is where you can actually enter a limit order, a market order, or like a stop limit order, bracket order, or like T-word order, right? So this is where you can choose a price that you want to enter at. So for example, you want to enter at 106.10675 right here, but price is only at 1065 right now. You can place a limit order at this price, and then once price eventually get up to that price, your exchange will automatically take you into the trade itself. So that's basically what limit order means. Market order is where you just enter for the trade right now based on the market price, right? Based on the price that Bitcoin is currently trading at. And then over here, this is where you can decide like how much money you want to be trading, right? It could be $100, $1,000, whatever amount of money you want to be trading, just go and put it in here. Okay, so the other stuff is like notional value, margin required. You can see everything is explained on the screen right here. Notional value is pretty much the value of this order before fees and leverage, calculated based on the price of the underlying asset times the contract multiplier. And then margin required is the amount of funds before fees that must be available in your account to place an order based on the current market price. So it's basically you need to have like this amount of money so that you can actually place this large of an order. And if you don't have that, then you cannot place that order. Or even if you do with leverage, there's a very high chance that you're gonna get margin caught, which means that the exchange is gonna liquidate your position if it goes against you, it goes against your trade ideal. If it exceeds your account balance, right? If it exceeds the margin itself, which means you're gonna blow your account, all right? So that's pretty much what it all means. And then you can also place your take profit and stop loss right here. Stop loss is pretty much you place it at a level which invalidates your trade ideal. Take profit is where you place it at a level where you want to get out of if price actually does go in a way. As simple as that. Like I said, very important. Every single trade, no matter how confident you are, just place your stop loss and take profit. All right, so yeah, that's pretty much everything. The last thing I'll probably go through is probably like this orders and position right here. Okay, so this orders over here, once you open a position, this is where you'll see all your open position over here. And then this is where you can also see like all your P&L, price filling you in, so on and so forth, right? Basically everything about your trades will happen over here. And this is pretty much it, right? We pretty much just cover everything. Yeah, deposit money, manage your funds right here, right? And then you can also go to like the portfolio over here, look at your crypto portfolio to see how it is doing. But yeah, other than that, I don't think there's much else for me to cover itself. You can see all your orders in here. And then this is more of like the referral program. And yeah, that's pretty much how you use the Coinbase platform to trade. So If you want to start, right, like I said, if you want to trade, just use the advanced platform. If you're investing, just use the basic platform. It's more than good enough. It's more than sufficient. It allows you to see all how your crypto is doing as well. But yeah, if you want to actually trade actively, come on to the advanced platform. Go for spot trading at the start, right? Trade with the money you can afford to lose. And then eventually, as you get competent and you know how to use leverage and you actually know what you are doing, then you can think about trading derivative, which is a little bit more risky because once again, you got leverage actually involved. But yeah, that's pretty much it. Let's go back to the slides. All right, let's clear up one of the biggest misunderstandings that most beginners have. Trading and investing, not the same thing. Both super powerful. Both can make you super rich. But they require completely different mindsets, completely different strategies. Investing is like planting a tree. You put money into strong assets, you let them grow over time, you let your profits compound, and you don't touch them for months, years, or decades. Your job is patience. It's just hold the investment as long as you want, as long as you can, and just let the runway do its thing. Trading is like being a surgeon. It's all about precision, timing, and discipline. You're entering and exiting positions based on setups, not based on vibes or hope. If you try to invest with a trader's emotion, you're going to panic sell and you're going to miss the upside. And if you try to trade with an investor's patience, you're going to hold on to losers and you're going to blow your account. So here's the rule that I always tell my students. Investing builds wealth slowly. Trading accelerates it if you are disciplined. Once again, you need both. But confusing the two is how people blow up. So if you're a complete beginner, you're much better off starting as an investor. Start with investing in Bitcoin and Ethereum to build a base. Like I said, just allocate maybe 10% of a paycheck into it, right? And then slowly learn trading on top of that. And please, for the love of God, do not jump straight into a 50x altcoin leverage trying to be a hero. The people who blow up accounts aren't dumb. They just mix these two worlds together and apply the wrong mindset, the wrong strategy at the wrong time. That's it. All right, now that you understood the difference between investing and trading, let's get into the real stuff. Let me actually show you how to trade crypto step by step. And listen, before I do so, I just want to say that I didn't start as some genius, okay? I still remember my first ever crypto trade. It was on Shiba Inu coin back in 2020. I had put like $100 in, which was like all I had at that point of time. So I thought that I was going to be some future crypto king. And then guess what? I lost all of it in a few days. And the exchange that I had actually deposited my money in is FTX. So my money was lost. The broker shut down, I think, a few months later. And the funny part was, I acted like it was the end of the world. Like my life was over. And looking back now, it's hilarious. It's quite funny if you think about it. But back then, to be honest, it hurt a lot because once again, that's all I had in my account. And I was like hoping that I could like 100x, you know, the Shiba Inu will go from 0.0001 cent to like $1. And I will like freaking 100x my money. But yeah, it didn't, obviously, because I had no plan, no system, no risk management. I was just listening to what my friend was telling me to buy. I was just clicking buttons and just praying for the best. So please, I really do not want you to go through that. So I'm going to walk you through this properly, slowly, from how to pick a setup, to how to enter, how to exit, how to protect your money. Because the goal isn't to make money fast. The real goal is to not lose money fast. That's how you survive long enough to get good, to get competent, so that eventually the market will reward you. Now, before we jump into trading view, I want you to know exactly what you're going to learn. I don't believe in giving you 99 different freaking patterns and ask you to memorize them, or just copy these different indicators, which is just going to end up confusing you. So what I'm going to do is that I'm going to show you 3 simple setups that actually work. When the market is trending, you buy the pullback. When price breaks out of a consolidation or of a particular zone, you wait for the retest instead of chasing it like a retail trader running on FOMO. And when the market hunts stop losses, we trade the reversal, not the panic. Remember, simplicity skills and complexity kills. If you can only master these 3 strategies, you don't need anything else to make serious money. So with that said, let's go on to the actual charts itself and I'll show you exactly how to spot them and execute them. Alright, now let's get to the fun part, which is the charts, which is learning about the trade setups that you can spot in the market in order to trade profitably. And once again, when I trade crypto, I only care about these 3 clean, high probability setups. If you can just master these simple setups, you will never look at trading the same ever again. You won't be relying on any indicators or complex strategies. And I like to believe that simplicity is the ultimate sophistication. Anybody who tries to sound clever, who tries to make trading sounds extra confusing, is trying to sell you something. Because they are trying to make it sound like it's so complicated and confusing so they can buy their course. So that you can actually buy whatever that they are selling, right? For me, I believe that simplicity is the highest form of intellect. It's not trying to sound smart or trying to sound intelligent, but the ability to simplify a complicated concept in a way that a 5-year-old can understand is a skill that many people lack because they don't understand the concept enough, right? So I'm going to share with you these 3 strategies, and I'm going to simplify each strategy down into 3 steps. Once again, because I understand this shit because I live this thing every single day. I actually trade this, right? So if your trading guru cannot explain his strategy in 3 sentences, he doesn't have one, all right? He is a fake guru. All right, so first of all, let's look at the trend pullback strategy. This is the simplest. This is pretty much like my bread and butter. Basically, what you want to understand is that price will never ever move up or down in a straight line. It has to breathe. It has to create this natural ebb and flow. You know, it has to breathe in, breathe out, breathe in, breathe out. So price is not going to do this. Price will go up, create higher highs, higher lows in an uptrend, all right? It would move in like this zigzag manner. And a downtrend, price will create lower highs and lower lows, right? So once again, this just means that price is pretty much going down and the sellers is in control of price, pushing the price down. That's it, all right? Higher highs, higher lows. And if price is not creating higher highs or higher lows and it's just in a consolidation just like this, then we know that there is no trend, okay? Price is just in a consolidation. There is no clear trend direction. So the first step is always identify the trend direction. So if I'm looking at this chart right here, I can see that the buyers are obviously in control of price since price is going up, right? And how do we know price is going up? Well, we look at the structure and we see that price has created higher high, higher low, higher high, higher low, and potentially create like a higher high right here. So this is where you can potentially mark the break of structure at the price point where price actually broke past the last swing high. Okay, so that's the bullish break of structure right there. And then later on, price has taken out this swing high right here. And I prefer if the candlestick actually close. If the candlestick actually close above this swing high right here, that's how I define as a valid break of structure. If it's just a candlestick wick break just like this to me is not really like valid, all right? This could just be a liquidity sweep. So let's continue to observe what price does. There we go. We got a candlestick closing above the high. That is a valid break. So that's the first step, identify the trend direction. So we have established that right now we are in a bullish trend direction. The buyers are in control of price, which means that we want to trade with the trend direction, which also means that demand is in control right now. All right, demand, not supply. So if that's the case, I want to be marking up the demand zones, which I'm expecting price to pull back to create like a high low before continuing to the upside. So if I'm looking at the chart just like this, I want to mark up all the demand zone. The demand zones that actually break structure. And I always start off from the extreme, right? So you look at the extreme low right here, the lowest low that led to the break of structure, and you begin marking up your demand zone, right? So there is one demand zone right here. Price came down, started reversing, and then came down, mitigate this extreme demand zone, started pushing up again. So this is where potentially you can draw another demand zone right there. And then since then, price has went up, make a tiny pullback before going up again, right? So that's another low demand zone right there. Okay, so I'm not really going to go too deep into how to actually properly draw supply and demand zones. I've got countless of videos on that on my YouTube channel, so go and check that out if you don't understand how to draw supply and demand zones properly. But there it is, right? You got the extreme demand zone, followed by this demand zone right here, and then this demand zone. It's basically the zone where there's like this reversal, right? From sellers to buyers, right? You can see clear as day, reversal, buyers take back control of price, price comes down, reversal again, buyers take back control of price, price goes up, and then comes down, buyers take back control of price again, right? So it's pretty much like those zones where you can pretty much see signs of reversal. So now, all you want to do is to wait very patiently for price to pull back to either one of these point of interest right here, either one of these demand zone. The reason why is because, like I said, price will never ever go up in a straight line just like this. Price will have to go up, pull back, create like a high low before you go up even further. And you don't want to be buying right here. Because if you're buying right here, you are going against the internal structure, which pretty much states that price is potentially making a pullback right now. So if you're entering right here, you might be right in the trade ideal. You might be right thinking that price is going to go up even further, but you're going to be wrong in the short term because in the short term, price is technically still bearish, which is also why we relax. We don't do anything until price mitigate our point of interest, right? So let's continue waiting. Price come down to our near demand zone right here, but does this demand zone, look at it, does it? No, price just blasts right through it. So at this point of time, it just tells us that supply is still in control of price. We are still in the pullback phase. Okay, so we shouldn't be looking for longs. So since this zone has failed, I'm just going to delete this noob zone right here. So cool. Now, we just continue waiting, right? We continue waiting for price to actually mitigate the next zone. Cool, price has mitigated this zone right here. It never really mitigated it. It never really touched it. And it just started pushing to the upside. And reason being is because it doesn't have to mitigate the refined zone. Right, so what happened right here was that if I were to actually mark up like this demand zone right here, I'll mark this entire pivot instead of like this extreme zone. Right, so this entire pivot right here, this actually constitute as a valid demand zone. Right, so the minute price actually mitigated this valid demand zone, this is where you can potentially enter upon the mitigation of that demand zone itself. Right, you can enter for a long order right here, the minute price actually mitigate that. Place a stop loss below the demand zone and just target to like maybe somewhere around here. All right. And you can see eventually price started consolidating, right? And then it eventually went up there and smashed a TP. So the thing is, even if you fail to actually enter upon the mitigation of this pivot zone itself, right? Because you actually you actually put your demand zone as like this refined candlestick right here. Guess what? Later on, you still got tapped into the trade, right? So you can see price came down here. Later on, mitigate our extreme demand that we have marked up right here. This is where easily could have entered for longs right here upon the mitigation of the zone. Place a stop loss below that low and target 3R just like this. Right? So either way, you would still be tapped into the trade itself. Alright? Once again, very, very simple strategy. No rocket science, just purely trading price action. Right? So just to recap, basically what you want to do is to identify the trend direction. You want to wait for price to pull back to a point of interest, and you want to wait for price to sweep liquidity. I forgot to mention about the sweeping liquidity part, right? But in this particular case itself right here, when price actually pulled back to this zone, did it sweep any liquidity? Yes, it did, right? Because at this point of time, price came down here, mitigated our demand zone that we have on the left-hand side right here. And when it does this, retail traders are going to be entering for longs. They might think that this is the new high low that is being created right here. So they enter for longs right here at this reversal. They place their stop loss below this low here, right? So that's just available liquidity being built up. So that did not work out because later on price just went down there, swept that liquidity before the real move actually happens. So that itself is a liquidity sweep. So always want to make sure that you only enter upon a liquidity sweep. Next, price later went up. Pull back to our extreme zone. This time around, did it sweep any liquidity? Yes, it did. If you look at the left-hand side, price actually came down, swept the liquidity that we have below this low right here. So, for the retail traders who enter for long right here, guess what? They're going to be placing a stop loss below this low. So, clear as day, price gravitated towards that and triggered all the stop orders, the different stop orders, grabbed some liquidity before they actually caused price to reverse to the upside. Right, so this is pretty much like a non-negotiable. You must always wait for a liquidity sweep because liquidity essentially acts as fuel for price to actually move to the upside, for price to actually get sufficient momentum. And they pretty much allow us to spot smart money footprints. Now, just to give you like a bonus tip, if you look at the left-hand side, what do we have? We got price coming down here. And when price is pulling back over here, guess what? Creating some available liquidity. Later on, price came down. Price came down right there. Swept all the available liquidity, create this sharp V-shaped reaction, right? Swept the liquidity below these lows, and also swept the liquidity below this low here as well, before price actually goes up. And before price actually went up, guess what? It came down here and mitigated the demand zone that swept liquidity before it actually went up. So this is pretty much an institutional demand zone, right? That right there is an institutional demand zone, which also means that over here, price is gravitating towards that institutional demand zone that is unmitigated. This is the first time around institutions actually got into Bitcoin. This is the second time round. And this is the third time round, right? So you can see this is where they start scaling in. And guess where's the fourth time round? The fourth time round is going to be the demand zone that swept liquidity, the most recent demand zone that is unmitigated. And where will that be? Where shall that be? Well, look at what we have. Price swept liquidity below this low right here, and then started pushing to the upside, right? So sharp V-shaped reaction just like this. So that's a liquidity sweep, which also means that there is a demand zone that can be marked up right there. So this entire thing will be our demand zone that swept liquidity. And observe what price does. Price went up, pull back to the demand zone that swept liquidity, huge buying momentum set to the market and caused price to just absolutely skyrocket. This is what happens when you understand liquidity. So even if you miss your entry right here, you miss your entry here or here, right? I mean, if you miss your entry here or here, guess what? This would be your third opportunity for you to actually enter for a long position. And guess what? Where is price going to gravitate towards next? It's going to gravitate towards this new demand zone that is being created right here. And then this is where you can start to see price will potentially come back, mitigate this zone, and continue going up. That's how powerful the trend pullback strategy is. Ta-da! Magic! As simple as ABC. Like I said, man, like if your trading guru cannot explain his strategy in 3 sentences, he doesn't have one. All he has is something to sell you. All right, so cool. That's the trend pullback strategy. Next, let's move to the breakout retest strategy. This one is even simpler and it's even more precise. And when I'm talking about breakout retest strategy, I don't mean the, oh, price is going to break out above a resistance level and we wait for price to pull back to the resistance level and then we enter for a buy. No, that is like some retail bullshit, right? That's the retail trading concept. We don't do that here. We are talking about breakout retest in the form of institutional context, which means that we want to smart money footprints. Like that's all we are trying to do. So if I'm looking at this chart right here, like I said, we have covered how to trade trending market. In a trending market, you want to trade the pullback, right? But what do we do when the market is going sideways? When there is no clear trend direction? How do we trade this? Do we just buy at support and sell at resistance? No. Once again, that is retail strategy. If you do that, you're going to be the exit liquidity, my friend. So what I'm going to teach you is a specific method which has worked really, really well for me in terms of how to trade the consolidation. And that is not to trade the goddamn consolidation in the first place. Because in my entire trading career, I have lost a lot, and I mean a lot of money trying to trade this consolidation, this sideways market. So I will try to enter for a buy right here, and then later on price will come and stop me up. Then they start going against my way because of manipulation, because the price is extremely volatile and unpredictable when it's in this shop right here. So you're much more better off just staying out of the market when price is consolidating. Just don't trade it. Which means that you want to trade the breakout of the consolidation. Because the breakout of the consolidation usually determines the real move. And when does consolidation actually happen? It happens when there is a pause in a trend. If you look at this right here, this consolidation did not happen out of nowhere. It happened because price went down, not enough momentum, so it started consolidating. Price went down again, not enough momentum to continue going down. It needs to grab more liquidity, grab more supply, started consolidating again, and it starts dumping. Right? So this is pretty much like how order flow works. Okay, like I said earlier, price will never just go down straight or go up straight. It has to go down, pause, go down again. And this is the concept of imbalance, balance, and then imbalance again. Right? And the market will always do that. It will always try to seek fair value. So now let's take a look at this right here. How do we actually trade this? First things first, I've identified that this is the entire consolidation. So nay, hell no. So I'm not going to trade this whatsoever. So what I'm going to do instead is that I'm going to draw a box. I'm going to draw it from the lowest point of the consolidation to the highest point of the consolidation. right? Which is like this kind of stick right here. And I'm just gonna do this. So I draw a box just like this. This, nada, no go. I'm not gonna try to trade this. I'm not gonna try to buy here or sell here, no. What I'll do instead is to wait for price to break out of the consolidation. And here is the non-negotiable part of this strategy. I want to see price break out of consolidation with a momentum candlestick. And ideally, that candlestick is aligned with the overall trend direction of price. What I mean by that is that if you look at this, the higher time frame is actually bearish right now. So the breakout candlestick is the one that I'm looking for. Is going to be a bearish momentum candlestick. A big, fat, juicy, big, fat, red candlestick. Big, fat, hairy, red candlestick. That's what I'm looking for, all right? That, my friend, is a freaking gold mine. If you can see this, you can pretty much see that that is just institutions shouting at you saying that, hey, I'm actually entering for a sell right here with freaking billions of dollars. My friend, that's a sign right there. That is literally their footprint. So like I said, you want to wait for price to break out the consolidation with a huge momentum candlestick. And when it does, what do you do next? Do you FOMO and start entering for a sell right here? Oh, if I enter for a sell right here, guess what? I'm going to place my stop loss all above like this high right here. Not ideal, right? So if you enter for a sell right here, you're just getting FOMO. And the next thing you know, you enter for a sell right here, price starts making like this, immediately sharp pullback. And guess what? You get stopped out, or like you start panicking, you get margin call, you almost get liquidated, and be like, oh no, I'm going to go back to fry burgers and McDonald's. No, that's not how it works, all right? What we want to do as professionals is that we never ever trade based on fear of missing out. We trade based on our plan. We trade based on our strategy, based on our entry criteria. If there is no confirmation, no entry, as simple as that. Which means the third step is to enter upon the mitigation of imbalance of the momentum candlestick. What I mean by that is that over here, when there is this huge, juicy momentum candlestick that is telling us that institutions are looking for longs, looking for shorts, we don't do anything yet. We wait for the next candle. Once we got the next candle, this is where we can identify the imbalance. Like I said earlier, this is the key concept we must understand. The market will always move from imbalance to balance, to imbalance to balance, to imbalance again. Which also means that when price creates such an imbalance move to the downside, like have such a huge momentum candlestick just like this, the market will eventually pull back to balance the market out, to find fair value before it goes down even further. And we want to try to capture this lower high right here. So at this point of time, identify the imbalance, right? Instead of entering right here upon the creation of this momentum candlestick, identify the imbalance. What the hell is the imbalance, Brad? What are you talking about? Speak English, please. Imbalance is pretty much the gap that is being created while price created this momentum candlestick. And how do you find the gap? You look at this big momentum candlestick right here. You identify where price was before, like the candlestick right before this momentum candlestick printed, which is this one right here. And you find the candlestick right after momentum candlestick, which is printed, which is this one right here. Okay, so you have identified the candlestick before the momentum candlestick and also after the momentum candlestick. Cool, Gucci. Now, the gap between the low of the previous candlestick and the high of the following candlestick, this creates what we call the imbalance. And this is where price is going to be gravitating towards. And that is where we want to enter at. We want to enter upon the mitigation of the imbalance of the momentum candlestick itself. So what I'm going to do is that I'm going to draw a box right here. Once again, to signal, to identify, to mark up this gap right here. And this is where we have our good old juicy imbalance. Which also means that I don't do anything until price mitigate this zone. Okay? So eventually price went up there, mitigate the imbalance. This is where you can potentially look for a sell order right there. Or you can even place the sell limit order like right at the edge of like the imbalance itself and place your stop loss above the imbalance. Or if you want to be safe, super duper safe, place it above the momentum candlestick just like this. And then same thing, to keep this strategy simple, we're going to target 2R, right? Just like 2R, maybe just like this. Okay, very simple 2R. And look at what price does next. It actually pull back deeper into the imbalance. It usually, right, once again, this is a pro tip, it usually mitigates the 50% of the imbalance. You can see, I didn't even mark up this 50%. I didn't knew that price is going to go to the 50%, right? Because this is fair value, right? This is the equilibrium. So yeah, you can see price usually mitigate the 50%, started going down right now. Continue being patient. Eventually, price starts consolidating a little bit, right? And just dumps. Guess what? Smash our TP just like this. As simple as this. But before price actually smash our TP, what do we have? Ask yourself, what do we have? Well, my friend, guess what? We have another freaking consolidation. Like I said, the market is always going from imbalance to balance to imbalance. So when we have another consolidation, what do? Do we trade it? No. We draw our box from the low to the high of this consolidation just like this, drag it to the right side just like this, and now we do the next step. You wait very freaking patiently for price to break out of the consolidation with the momentum candle itself. In this particular case, where is the momentum candle? This one right here. Or rather, where is the candlestick that actually caused price to break out of this box? Because that's the candlestick that tells us that there is a lot of volume, a lot of selling volume. Well, it's not this one. It's not this one because this is so small. It's this one right here. So we have identified the momentum candle. Next, we look for the previous candle that created the momentum candle. And we look for the following candle that was printed right after the momentum candle. And guess what? This is how we find the imbalance. This is how we find the gap. Okay, so you draw the gap right here. From the low of the previous candle to the high of the following candle, drag it all the way to the right hand side. This is your imbalance, which means after this momentum candlestick is formed, you don't get FOMO. You wait very patiently for price to actually mitigate that imbalance. And once it does, easy sells, enter for like a sell order right here. Like I said, either place your stop loss above the imbalance or place it above the momentum candlestick just like this and target, let's say like 2R, right? Or maybe let's try to go for like 3R. Maybe 3R will work out. Let's see. Okay, eventually price goes down, smash our TP before price starts reversing again. Now, just to show you that this strategy works on all time frames, I'm going to go down to the 5-minute time frame and show you magic. If you go down to the 5-minute time frame, you realize that price is fractal, which basically means that whatever happens on the higher time frame must first happen on the lower time frame, which also means that whatever patterns you see on the higher time frame will be the same in the lower time frame, will be the same in 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly time frame. Whatever patterns that you can see, it appears everywhere, right? That's what I mean when I say price is fractal. And look at what we have here. Okay, so this is us going in the trade, right? Us celebrating, yay, we're gonna quit our 9-to-5 job. You know, F our boss. I'm gonna fire my boss, right? Cool. Now, while price is going down there to smash our TP, what do we have over here? We got price creating a consolidation again. But this time around, it happened in the 5-minute time frame. And I want you to observe what price did. Consolidation, mark out the box right here. Cool, Gucci. Now, where is the momentum candlestick in this particular case itself? This one, it gets a little bit confusing, right? You probably say that it's this one right here. But if you go down to the 15-minute time frame, you will see that this entire thing is the momentum candlestick. This is the candlestick that caused price to actually broke out of the box itself, which also means that this is the previous candlestick and this is the following candlestick and this is the imbalance that we have right here. And guess what? Price went up there, mitigate this imbalance before going down again. I literally can't make this shit up. Like I literally just spot this while I'm actually analyzing the chart itself. It's the exact same concept, but it's applied on the lower time frame itself, or rather it's more obvious on the lower time frame itself. Okay, so consolidation, breakout, retest, and then you trade the continuation of that retest itself. But you don't ever trade the consolidation, you don't trade the breakout, you trade the retest of the breakout. Because the retest of the breakout validate the breakout. It allows you to trade in the real direction instead of like some fake bullshit trend direction. All right, so that's the second strategy, the breakout retest strategy. Like I said, I'm doing my best to really simplify this strategy in English, right? As simple as humanly possible. Which brings us to the final strategy, which is the liquidation sweep reversal. Now, to me, this is my favorite. And I personally think that this is the most high probability one compared to like the other two strategies, right? Because I've seen this play out 1,000 times by now. Price always respect liquidity. Liquidity and timing. All right, so here's what I mean. Liquidation sweep reversal is just a fancy name of waiting for price to sweep liquidity and entering upon the mitigation of the zone that swept liquidity. So similar to like what we have on the pullback strategy that I just showed you at the start of this tutorial itself. First step, identify who's in control of price. Remember supply and demand. There's either buyers or sellers that is in control of price. And it's very, very clear when you actually identify the market structure. The structure tells you the trend direction. So if I'm looking at the structure right now, I can see that buyers are in control of price. How do I know that? Well, because price actually went up, higher high, higher low, higher high, right? And then potentially creating, higher low right here, but then potentially creating a higher high. But it did not really create a higher high, and then before price came down here. Nevertheless, buyers are still in control of price, at least on the internal structure. On the higher time frame structure, it's just like a massive chop right here, right? But you can see, even in this massive chop, you can kind of gauge the trend direction. Price went up, and then it goes up, goes down, and then right now we are potentially on the move to the upside right here. So now we have identified that buyers are in control of price. It's not the best example, right? Because after all, on the higher time frame, price is still kind of stuck in this consolidation, but it's sufficient, right? So cool, we have identified that buyers are in control of price, which means we want to trade from demand zones, right? Which means we don't want to sell, right? Because when price goes up, it can go up even higher, which also means that we don't want to trade from supply zone. We only want to trade from demand. Now, the next question becomes, cool, Brad, where's the demand zone? Which brings me to the next step. Mark up your liquidity zones. And ideally, it should be a point of interest, a zone that is aligned with the trend direction that swept liquidity. That's what I mean when I say a liquidity zone. That's what I mean when I say an institutional zone. So in this particular case itself, we saw that price went down here, create equal lows. When there's an equal low just like this, retail traders, they're going to enter for longs, right? Because that's all textbooks say. Oh, buy at double bottom. And guess what? That is just available liquidity being built up below those lows right there. Good old juicy liquidity. I'm talking about like medium drastic liquidity things right there, yeah? So later on, price came down, swept all the stop losses, liquidate all the retail traders, the poor little retail traders. Now they have to go back to work at McDonald's. Now they are crying because they are frying burgers instead of looking at candlestick charts. Cool. But if you're a professional trader, you know exactly what you're doing and you understand the game. And guess what? You can either blame the game or play the game. And if you plan to play the game, you might as well win. Which is why it's so important for you to understand liquidity. Right? So at this point of time, price came down here, swept all the stop losses right here, swept all the liquidity. This is clear as day a liquidity sweep. Because price took out the stop losses right here, and he also gave us like a very sharp V-shaped reaction just like this. And when he gave us like a sharp V-shaped reaction just like this, guess what? It also broke structure in the meantime. Because if you go to the 1 hour time frame, you can see that over here, price was creating lower highs, lower lows, lower highs, lower lows. Later on, price reversed and caused price to start creating higher highs and higher lows. Right? So it caused price to actually broke structure. And this is the origin point. Like this entire move to the upside, it originated from this area right here. Which is also why I can be comfortable, I can be confident to say that there is a demand zone that swept liquidity at this price point right here. Okay? This is the demand zone that swept liquidity. This is our liquidity zone. Third step, enter upon the mitigation of the liquidity zone. What does that mean? That means you don't do anything until price gets to that zone. Like I said, the hard part in trading isn't spotting in A+ setup. It's in ignoring everything else. That's what makes trading difficult. right? Because your fingers start getting itchy, you start entering for a buy right here because you hear a friend saying that Solana is going to go up to like $5, no, not $5, but like $300 or whatever, right? And then start entering for a buy right here. You're getting in at the wrong price, at a wrong time, at a wrong freaking place, right? So you shouldn't be lamenting on why you're unprofitable. So that's not how we do. That's not how we operate. We don't operate based on emotions. We don't operate based on guesswork. We operate based on structure, based on order, based on rules that is pretty much governed by our trade plan, right? Which is why you don't do anything here, okay? You chill. You set an alert at this price point right here at the liquidity zone, and you do nothing until that alert is triggered. So you wait very patiently. Once price step into the zone, perfect, man. And by the way, this is the entire pivot, right? I'm drawing up the entire pivot, but if I were to draw up the refined demand zone, this will be the refined demand zone, right? That's the one that I'm really interested in. But anyways, price made its pullback, right? Once again, price has shifted in the bearish in the short term. Are we surprised? Do we think that, oh, Solana is going to go to $0 right now because price is going down? No. We know that price has shifted bearish because it has an objective. And the objective is so that it can facilitate the pullback into this liquidation zone, so that more institutions can actually enter for more long positions, right? They can actually quietly accumulate their buy positions. As a result, price starts pulling back into this price point right here. And when that actually happens, cool. This is where you can enter upon the mitigation of the liquidity zone, right? So you can enter for like a buy order upon the mitigation of the zone itself, right? And you can potentially place your stop loss below at like this reversal candlestick right here. And you can target 3R or 2R or whatever your trade management method is. Now, before I actually play this trade out, I want to show you something. When price actually does this, notice how it just doesn't it didn't mitigate this zone and just starts reversing and go back up. Instead, it came down, mitigated that zone, then it came down, swept that liquidity right here below this low right here before it actually started going up. This is what I mean when I say that no matter what happens, there always needs to be some form of liquidity sweep. Like that's my favorite word in my trading dictionary, liquidity. Because if you can't spot the liquidity, then you are the liquidity. So, like I said, instead of blaming the game, learn the rules on how the game is being played and freaking win. That's what I'm trying to do for you. I'm rooting for you to win. That's why I'm showing you the secret sauce right here. So you better you better like this video. Anyways, price started reversing right here at this high. After it swept liquidity, boom, we got our entry in there. We target 3R, and let's look at how these beautiful positions play out. Right, down price consolidate a little bit. If you actually place your stop loss like a few pips below this low right here, you give it a little bit of breathing room, you will not get stopped out. Right, and eventually price went up there. Now, here's one thing I wanted to take note, right? Let's say you get stopped out right here, okay? Let's say you get stopped out right here because you are the freaking liquidity, all right? Let's say you place your stop loss below this lows, you get stopped out. It is what it is. You are the liquidity. Guess what? You can actually look for another entry right here. So I personally have a rule that I will attack a point of interest, I will attack a trade idea twice. So if I get stopped out right here, I can enter right here. And then I'll place my stop loss once again below the reversal candlestick that mitigated at this liquidity zone. Because you are still following the rules within the trade plan, right? This is not you refusing to accept the fact that you're wrong. No, this is you trying again. And one thing I want you to understand is that no matter how good you get at understanding liquidity, you will never ever be able to predict with 100% certainty when it's going to be the last liquidity sweep. Like, look at how many liquidity sweep we have before price actually moved to the upside. 1, right here. 2, right here. 3, right here, before you got sufficient liquidity and pumped to the upside. So, trading is a probability game. And all we can do is to really try to wait for as much confluences as humanly possible to stack the odds in our favor, right? To stack the chances on our side so that Lady Luck can shine on our side. And we do that by understanding liquidity so that we can avoid being the exit liquidity. So we can do our best to spot the last liquidity, right? Like I said, do our best, not predict it with 100% predictive power, because that's impossible. You will never ever know what smart money is thinking. But what you can do is spot their footprints and follow their footprints. And that's what understanding liquidity allows you to do. So yeah, that's pretty much the entire trade setup right here, right? Very, very simple. Just to show you another example on this particular trade itself. Price went up there, right? Give us a market shift over here where price actually started shifting bullish. Once again, buyers are in control of price. And guess what? What we have right here, price went up there, broke structural, started pulling back, right? Coming back to strategy number 1. We know that price is pulling back. Where is price pulling back to? It's going to pull back to some form of demand zone, right? Demand zone has swept liquidity ideally. And this is going to be extreme demand zone. And this demand zone have also swept some liquidity below these equal lows right here. Okay, so price pretty much mitigated that. Started going up, but there was insufficient liquidity, okay? Insufficient liquidity. So as a result, where is the next available liquidity? Below this swing low right here. So later on, price went down there, swept that swing low there, before the real move actually happens. Right, so this is where if you're using this particular entry model right here, the liquidation sweep reversal, you'll be patiently waiting for the final liquidity sweep to happen, which means you will wait for inducement to be built up right here. You wait for the traps to be laid out by the smart money. In this particular case, price goes down, pulls back, goes down, pulls back. Equal lows right here. Juicy liquidity. You won't enter early because you know that this is simply a trap laid out by smart money, and you wait very patiently for price to swap that low, swap those equal lows right here. Then you enter right here. And then you place your stop loss above and the reversal candlestick, and you target 3R, and you smash your TP. As simple as that. Like I said, guys, simplicity is the ultimate sophistication. Simplicity scales and complexity kills. If you keep your strategy simple, methodical, structured, systematic, mechanical, you can already outperform 99% of the traders out there. Simplicity works. It's profitable, it works, and it's incredibly useful. So yeah, that is pretty much the 3 setups. Let's return to the educational materials and let's continue talking about how to tie everything together. Alright, now that you have understood the trading setups, just understand that that was just a minor component of your trading system. Let's break the entire trading system down piece by piece. And what I really want you to see is this. Profitable trading is not exciting. It's boring, it's methodical, it's structured, it's systematic, and it's repeatable. And that's what makes it scalable. If your approach feels exciting, random, and emotional, and discretionary, that's not trading, my friend. That's gambling. Okay, like you might as well just walk into the casino. Why trade? Go to Las Vegas. So these are pretty much the non-negotiables that govern a trading system. Number 1, entry, which is a clear entry trigger. Every single trade should start with a trigger, not a feeling, not fear of missing out, not, oh, but the influencer said I'm going to buy this, so I'm going to buy this. No, a clear entry trigger. And for me, it's a pattern, which is combined with confirmation. It's an entry model. Like what I just shared with you, right? The 3 different setups, the trend pullback, the breakout retest, the liquidity sweep. These are pretty much forms of entry triggers. So if you don't see your trigger, do nothing. No trigger, no trade. If I see my trigger, I execute the trade with confidence, without hesitation, reservation, or fear. That's it. Next, we got exit. Exit, there is 2 forms of exit. Stop loss and take profit. Stop loss is pretty much what happens if the trade doesn't go in your way. Take profit is how you will exit if the trade does go in your way. You need both, right? Your stop loss isn't where it hurts. It's where the idea breaks. It's where the trade idea get invalidated. Okay, so bear in mind that I don't place my stop loss randomly. My stop goes where if price hit it, I'm wrong, right? It's pretty much like I said, a price point which invalidated my trade idea. This way, when I get stopped out, it's not emotional. It's just data telling me that the setup wasn't valid. And I get out with like a small loss. So a stop loss isn't for protection. It's just proof that you're disciplined. And discipline pays, like literally pays. And it's the exact same thing on the other side. Winners are planned before the trade, not during the trade. You don't decide where to get out when you're in the trade. And that is exactly why before I get into the trade, I already know where I'm going to scale in, where I exit fully, and what invalidate the continuation. So once again, if your take profit is based on feelings rather than a plan, you don't have a strategy. You have a heartbeat and anxiety. And that's not trading the market. That's trading your own mental well-being. Next, for your risk, I would highly recommend you to risk at a maximum of 1% to 2% per trade. Risk control is the difference between surviving and restarting. It's essentially the amount of life that you have as a video game character. So if you run out of life, guess what? You're dead, right? Like if you run out of chips, you can't play. And if you can't play, you can't win. So I don't care how confident I am. No matter what, I stick to this risk per trade right here. I never ever size up because, oh, this one feels good and I'm so confident, because I know for a fact that every single trade has a 50-50 chance of working out, right? So no matter how confident I am, I cannot think that it's 80%. No, it's still 50-50. And always remember, discipline in size builds longevity, and longevity builds mastery, and mastery builds wealth. So trade not because you want to get short-term profits, but so that you can actually stay in the game long enough till you get consistent profits. And then next we got frequency. Frequency is basically the amount of trades you are allowed to take per day. And I like to treat it as the number of bullets I have in my rifle. So if I run out of bullets, I stop myself from trading, right? Like I literally can't trade anymore. So highly advisable for you to have 1 to 3 trades per day max. Okay, don't go more than 3 trades, because if you go more than 3 trades, you're kind of on the verge of over trading and giving back the profits that you have made, or compounding your losses. So once again, remember, in trading, you don't get paid for how hard you work or how many trades you take. You get paid for the quality of the decisions that you make. So more trades does not equal to more money. More hours on the charts does not equal to more money. Better trades equal to more money. So yeah, 1 to 3 trades per day, that's good enough to change your life and actually provide you with financial freedom, okay? If you take 9 trades a day, 10 trades a day, 15, 20 trades a day, my friend, once again, you're not going to be trading. You're just going to be stressed, scrolling, analyzing with money on the line. You're going to prone to make some stupid decisions because you're going to be super burnt out. It's unsustainable. All right, so if it's not written, it's not a rule. If it's emotional, it's not trading, it's gambling. And just remember this one last thing. You don't rise to the level of your goals. You fall to the level of your trading system. This is your system. Stick to it and you will get good. And you will get competent. And you will make money in the long run. Break it and the market will break you. The market will humble you. And this right here will determine whether you survive long enough to ever become a good trader. And I always love this quote of mine. Whenever I try to explain about risk management and people don't get it, I always say this poetic quote. Risk management is a love letter to your future self. And you're the only one responsible for delivering it. Just think about that for a minute. Just ponder upon that. Risk management is what allows you to stay in the game long enough so that you can actually profit. So it's essentially like you are just helping your future self. And once again, no one is going to be able to help you to manage your risk. This is not something you can outsource, right? This is something you have to do yourself if you want to stay in the game long enough to actually see the big wins, right? The outsized returns. And once again, people think that trading is all about finding the perfect setup. No, it's not. It's about not blowing up while you learn. So write this down somewhere in your mind. You don't lose this game from lack of wins. You lose from one stupid loss. You don't blow an account because of bad entry. You blow an account because you kept trading after the bad entry. So when it comes to risk management rules, highly recommend you to risk 0.5 to 1% per trade. Just like I mentioned, around 1% to 2% per trade, but I'll say like the bare minimum is probably 0.5%. Obviously, the bigger your account, the lesser you're probably risking, right? For example, if you have like $1 million account, think about it, like 0.5% is quite a lot of money. So I'll say anywhere from 0.5% to 2% would be good, right? Because like I said, this is essentially the bullets you have in your rifle. The more bullets you have, the more likely that you are going to stay in the game, because the less likely you're going to blow up, the less likely you are going to run out of bullets, right? So just stick to this risk per trade and you're going to be fine, because you don't get rich by going big. You don't get rich by winning this one big position. You get rich by staying consistent. And once again, I don't care how confident you feel. Confidence is not a strategy. Risk is. One losing day shouldn't destroy your month. One losing month shouldn't destroy your trading career. If it does, then my friend, you are risking way too much on each trade. You're over leveraging. Which brings me to the next little mistake. Avoid 20x leverage addiction. And I think I got a very good explanation for this. Leverage is like alcohol. A little can help you loosen up, socialize, have fun. But too much can allow you to wake up broke and confused. Been there, done that. And the thing about crypto is that it gives you these insane leverages, like 50x leverage, 100x leverage on your perpetual futures. Why? Have you ever sit there and talk about why? Well, it's because the exchange want you to blow up. When you blow up, they make money. So you're not really competing with other traders. You're competing with your own impulses. Another thing is, please, bro, stick to one, bro. I don't know why people actually do this. Maybe it's because of their dopamine fried brain from scrolling TikToks and multitasking all the time. But focus is a weapon. Distraction is a leak. And anything that doesn't move you closer towards your goal is simply a distraction. So you don't need 50 charts open. You don't need to trade 50 stupid coins. You just need 2 to 3 coins that you understand deeply. Bitcoin, Ethereum, highly liquid, a lot of trading opportunities, and maybe one narrative play, right? But just stick to trade at any point of time. Do not get distracted by the women in the red dress. Because the more charts you chase, the more mistakes you'll make. Next, avoid emotional drawdown. Revenge trading is how $1 million plans become $0 accounts. If you are angry, if you are tilting, walk away. If you are fearful, walk away. If you are feeling any sort of emotion after you get out of a losing position, walk away. Professional traders, they don't beat the market by fighting it because they know that that's essentially like trying to play a game where they can't win. The market always wins. You can't beat the market. Professional traders beat it by knowing when not to trade. So think of it like an athlete. When you're tired, you know that you're not going to perform your best, then don't perform. You're much better off just resting. Or just ensuring that you get back to a mental equilibrium before you actually get back to the charts. When you're emotional, you don't trade. It's the exact same logic right here. Because when you're emotional, you're prone to make bad decisions, which automatically means that you're going to get outcomes which you do not want to get, which means losses. And then you're going to get frustrated because of the fact that you were emotional in the first place. And then you're going to take a bad trade just so that you can actually offset the loss that you just incurred. And then you're going to lose another trade. And then you're just stuck in this vicious cycle until eventually your account go to zero. Once again, you don't blow accounts because of one big loss. You blow accounts because you keep trading after the big loss. So let this be a reminder. Your job is not to make the most money. Your job is to stay alive long enough to become competent. Because when you become competent, you become confident. And when you become confident and you have conviction in a trade ideal, eventually the market will pay you. This game rewards survivor first, skill second, and profits last. If you're able to protect your downside, the upside will eventually take care of itself. And here's the harsh truth. Most people lose in crypto not because they are stupid, not because they don't know how to analyze the charts, but because they have zero structure. Everybody thinks that, it's all about more indicators, more strategies, more coins. But the truth is, you can beat 90% of traders with simplicity and discipline. That's it. And this is how we build it. Firstly, focus on one setup. Pick one play and master it. Whether that's the trend pullback setup, the breakout retest setup, the sweep reversal setup, whatever it is, pick one and just master it. Whenever you see that pattern play out in the market, go and execute the trade with confidence. So don't use freaking 7 indicators or wait for 12 different confirmation signals or wait for all the different stars in the universe to line up perfectly for you to enter for the trade. No. The perfect condition does not exist. The perfect condition is entering for the trade when your rules say so. If you can't make one setup work, more setups just make you lose faster. Next, focus on one asset. Please, just trade one chart, bro. Either Bitcoin or Ethereum. When you chase 15 different altcoins, your brain turns into scrambled eggs. So you're much better off just mastering one market's personality first. And I always tell this analogy to my students. It's like dating. When you go on the date with a beautiful woman, For the first time round, you might get to know what she like to eat and what are her hobbies, and what's her job, like this surface level stuff. But you won't be able to gain like a deep understanding of who she is at a fundamental level until you have went on like at least 10 days or even like 15 days or even 100 days until she like move in with you. And then when she does, then you realize, wow, okay, this girl is actually crazy. It's like you actually get to know her after constant exposure with her. It's the same thing with trading, right? You cannot get to know an asset class if you're constantly skipping around. You need to spend more time exposing yourself to that particular asset, trade it as much as possible so that you can understand how it moves and how it behaves and what time does it does this, what time does it does this, and what are the best time to trade, how does it move, how does it fit into a trading strategy. And the only way you can understand that is if you just focus on one asset. Next, 100 trade rule. Do not judge a strategy after 2 losses or 3 wins. Judge it after 100 trades logged cleanly. Once again, not taken cleanly, but reviewed cleanly. A lot of traders, they quit on setup 4. They take 4 trades and then they lose all 4 trades in a row. Then they're like, oh my God, they start lamenting the market for being unfair. They start thinking that, oh, this is not for them, this is a scam. When in reality, you are literally quitting right before you finally learn what you are doing wrong. And if you can just learn what you're doing wrong and just eliminate that mistake, guess what? You're going to make better decisions in the future, more logical and objective decisions, and you're going to make money. So data beat feelings, right? Focus on gathering as much data as possible, become competent, learn from it, review it, right? So that eventually you know what to do more of and what to do less of. And screenshot every trade. Document what you saw before, during, and after your trade. Screenshots are essentially like your receipts. Receipts force you to be brutally honest. And trust me, your future self will thank you for the notes you take today. Emotion log. Trading is a psychology game with price candles as props. So always make sure you write down how you felt. Fear, greed, FOMO, overconfidence, whatever hope, whatever emotion. Make sure you track it. Because if you don't track your emotions, you won't be able to become conscious of them, which means that you're going to trade from them, which means you're going to lose money. So once again, just remember, consistency doesn't come from vibes. It comes from systems. Like I always say, a trading strategy is like an asshole. Everybody has one. What's difficult is the ability to follow it when you are going through a losing or a winning streak. Anyone, really anyone can have a strategy, but is following it that's hard. Anyone can follow rules when they feel good, when they feel disciplined, when they are focused. Discipline is following them when you don't feel good. So right now you can spend a lot of time doing all of this manually, like I did for years, or soon you will be able to do it inside one clean system. We are building that tool right now, the world's first trading super app. So if you want early access, make sure you join the Edgeflow waitlist. Link in the description. Trust me, it will change how you trade forever. Now, having a trading plan is step 1. Like I said, it's the easy part. It's like an asshole. Literally, everybody has one. Becoming consistent comes from refining that plan over time. And this is the part that most beginners skip because it's difficult. They just look for the perfect strategy, and when that doesn't work out, they skip to the next strategy. When in reality, the only path to mastery is to build one strategy and continue to reiterate it through feedback. So, the best information about your trading comes from your own trade. Yes, it doesn't come from YouTube, it doesn't come from Twitter, it doesn't come from indicators, it comes from your data. And this is my 5R process, and I think this is how professionals improve. Record your trades daily. If you don't track it, it didn't happen. Which means that you won't have sufficient data to actually review, which means that you're going to continue repeating the same unconscious patterns you have been repeating for the past few months or since the start of your trading career. And review what you did well and what you messed up weekly. No shame, just brutally honest truth, right? Just stare at your inadequacy and just like get better. And then reflect on the big patterns monthly. Are your losses emotional or are they technical? Are you breaking your trading rules or do you need to adjust your trading system? And then refine your trading plan quarterly. Make small tweaks here and there, right? Don't like just change the entire trading plan because for every single variable that you change in your trading plan, you need to test it again. right? So just make tiny changes. Only do it if it's necessary. Don't change things for the sake of changing it. If it works, don't touch it. If it doesn't work, then perhaps think about tweaking it and refining it. It could be an entry, it could be an exit, it could be the way that you manage a certain trade, and just continue to get better, continue to adapt. And then reassess your goals annually. Ask yourself this: are you trading for growth right now, or are you protecting capital? And then just repeat. Okay, you repeat this entire 5R process. And once again, this is the boring shit that actually pays. Amateurs, they look for new strategies every week. Professionals refine one strategy every single day. And this really ties down to what Bruce Lee said when he mentioned that, I don't fear the man who knows 1,000 kicks. I fear the man who practices one kick 1,000 times. Same thing right here. This is the boring shit that builds scary good traders. And guess what? This is the stuff that nobody likes to do, which also means that if you're able to do it, you're going to outcompete the rest of the retail traders out there, which also means that you're going to get exceptional results because you're an outlier. And because of the fact that you're doing what others won't, you're going to get the results that others don't. Now, let's talk about what actually kills most crypto traders. It's not the market, it's not the strategy, but their behavior. And once again, I'm just going to call this out as it is because I did every single one of these when I started. Number one, chasing pumps. Okay, if you are buying after a green candle explosion, you're not trading. You are just gambling because you fear of missing out, and you're just gambling your feelings. If everyone starts caring about a coin, right, like this coin starts getting a lot of attention, bro, you're already late. Like, don't get in out of FOMO, okay? You're already buying at the top, and it's gonna crash any point of time right now. So just remember, crypto rewards the patient, not the desperate. Meme coin addiction. Bro, meme coins is not a sustainable way to make wealth in this market. Meme coins is a lottery ticket. Like, that's all it is. And lotteries exist because they make money for the house, not you. Whoever that created a meme coin, that's the guy that's going to be laughing as you head to your slaughterhouse, as he pump and dump. And I get it. You know, you go onto X, you go onto Instagram, and you see screenshots online of people turning $100 into 20K, into a millionaire. But the thing is, you don't see the 99.99999 people who turn $100 into $10, into $0. If you want to allocate 1% or 5% or like 10% of your portfolio for fun, fine, right? But please don't build your life plan around like, I don't know, freaking dog pictures and like frog emojis, like the Pepe BS coin. Next is overtrading. Like I said, you don't get paid for activity, you get paid for accuracy. You don't get paid for shooting blanks like a freaking machine gun. You get paid for trading like a sniper. And if you're trading because you are bored or you need excitement, then bro, you're already cooked. Because professional trading is slow, it's boring, and it's extremely methodical. If it feels like a casino, then you are really the customer. Betting life savings. I told you, it's the Shiba Inu story again. If you put in money you can't afford to lose, your emotions will trade for you. Like I said, it could be the money you need to pay your rent, it could be your emergency money or your student loans. Do not put that into your trading account, please. Start small with what you can afford to lose and slowly scale with skill, not with hope. Man, and last but not least, this is the big one. If someone flexes cars and watches more than charts and execution, congrats, bro. You just found a marketer, not a trader. Instead, you should be starting people who trade live, who actually have a track record, who actually journal their trade, who actually show receipts, not just people selling lifestyles. So, simple rule here. If someone flexes their cars more than their trade, mute them immediately. Like, just don't even waste your time. Protect your attention like it's capital, because it really is in trading. And I always say that in the short term, the market is a voting machine. In the long term, the market is a weighing machine. So if you think about that in the trading industry, basically, trading gurus who sell this lifestyle, I rent Lamborghini for a day, they might win in the short term. But the professionals who deliver real value, who actually get results, will win in the long term. And this is why we are not playing the same game. It's like you can do all the flashy shit, but I'm just going to be over here providing as much value as humanly possible and just doing what I do best, which is trade. And this is the part where most people skip. You know, they want the Lamborghini timeline, but they don't want the boring work. Everybody wants the view, but nobody wants the climb. What you must understand is that trading isn't a gold rush. It's a skill. And skills follow phases. And it's essentially like going to university. When you go to university, you're sacrificing the next 4 years of your life in hopes of, getting a degree so that eventually you can work a 9-to-5 job. And once again, the thing is, there is no certainty that you're eventually going to land a job. So why don't you apply that same mindset into trading? Just trade the next 3 years of your life as starting the markets so that eventually you can make so much more than what your freaking degree can potentially earn you, right? Because that's all it is. It's a skill. And skill takes a longest time to master. So let me give you a simple rule. First you learn, then you earn, then you scale. And if you try to skip the steps, the market is going to send you back to step 0. So here's what I want you to do for the next 90 days if you are serious about trading crypto. Day 1 to 30, learn the basics, trade on a demo account, and build a trading journal. Once again, the first month is not about making money. It's all about building a solid foundation. So at this point of time, you're learning the trading platform, you're learning how to read the charts, analyze the charts, understanding setups, and building good habits. You're not here to make money yet. You're here to stop losing money for the rest of your life. You're here because you're sick and tired of being the exit liquidity. So, demo account, tiny lot size, tiny position size, screenshot your trades, take down notes, log your emotion, and just focus on the process. Think of it like learning to drive in an empty car park before touching the highway. That's really all it is, right? It's learning to walk before you can actually run. Just like this cute little baby emoji that you can see right here. Next, day 30 to day 60. So this is the next month, right? At this point of time, you want to trade small, collect data, refine entries. Now you trade real money, okay? Like now you can potentially trade real money. If you're not ready to trade real money, then you can just push this down further. But if you do want to trade real money, start with a small account, okay? But like a very small amount of capital, maybe $500, $100, whatever it is. Just enough to feel emotion, not enough to destroy your confidence. And at this point of time, I want you to treat that small account as you building a skill set of trading, which also means that this money that you have in the small account is going to be market tuition, right? It's going to be market tuition. So your goal in this particular phase is to just focus on gathering as much data as humanly possible. You are not chasing profits, you are chasing evidence that you can follow rules. You are not trying to make money, you are building competence so you can eventually have conviction in your trade plan, so you can eventually execute with a lot of confidence and you can actually make money from this market. So you're still in the apprenticeship phase. And whatever losses you incur right here, like I said, just treat it as market tuition because it is really the price you have to pay in order to buy wisdom. So at this point of time, you don't change setups, you refine execution. You test your trading plan. If it doesn't work, refine certain steps and just continue to refine your entry and exit. Day 60 to 90, this is where you just focus on one coin, one strategy, and you scale slowly. A lot of traders, they like to do it from like a wave perspective, which means they start trading 50 different coins using 10 different strategies, 5 different indicators, learn from 5 different mentors. That doesn't work. You need to focus on depth. Because in trading, depth will always beats width, which means that you need to focus on mastering one coin, learning from one mentor, using one strategy, and just scale slowly. All right, so once again, success is basically mastering one thing until it's so freaking boring, okay? You pick one coin, you pick one setup, and you do it again and again until it's muscle memory, until it becomes second nature. Your goal at this stage is not to be everywhere at every time. Your job is to become dangerous somewhere. Build that depth, not the width. And when you are consistent, then you can start scaling, right? You can start adding more capital. You can perhaps try to get funding, but only when you have a consistently profitable track record. Only when you feel ready. So scale, not for the sake of scaling, but because your data says so. So that's what I want you to do for the next 90 days if you plan to trade crypto. And I just want to say that in 90 days, you won't be rich, okay? You're not going to have $1 million in your bank account if you do this for the next 90 days. But you will be competent. You will be experienced. And competence is the real edge. A lot of people, they sabotage themselves because they want speed over mastery. You know, they want things fast. But the thing is, the market doesn't reward speed. It rewards patience. You're not trading to get lucky. You are trading so you can become a freaking money printing machine. So that eventually you're able to analyze the charts like the Trading Geek and just extract a shit ton of money from the charts. But like I said, it's not gonna come in the next 7 days or the next 90 days even. It's gonna come when you have mastered the skill set. Now listen, crypto doesn't reward the smartest. It rewards the most disciplined. You don't need 10 different monitors. You don't need a magical indicator. You don't need a holy grail ICT strategy. You don't need to chase every single coin on Twitter. What you do need is a proper trading system, a trading journal, proper risk control, proper emotional control, and time in the trenches. And people always underestimate the last factor right here. It's like no matter how good you get at analyzing the charts, you still need time. Right? Because time plus experience equal wisdom. The reason why I can spit all these amazing trading philosophies and just spit this raw game at any point of time I want is because of the fact that I have just so much experience under my belt. And the reality is this market, it will make you money, it will take it back, it will teach you humility, and then it's going to reward you again when you are disciplined enough to deserve it. And most people, they give up when they get to that last phase. And look, once again, I'm not here to pitch you anything. I don't need your money. I'm already good. Now I want you to get good. So here's what you should do next. Don't chase hype. Don't chase trading lifestyle influencers. Don't gamble. Don't rush. Go and watch this free market mechanics playlist I've created for you. It's everything I wish someone has handed me in year 1. Master those videos, master those concepts in those videos, apply them for the next 90 days, journal, grow slowly, earn your confidence with data, not dopamine. And if you commit to discipline, you'll be shocked at who you'll become in a year. Because this game is not about luck. It's about doing what most people are too impatient to do. So yeah, go and check out this free trading courses playlist right here, and I'll see you at the top. Not because you got lucky, but because you have earned it. Remember, you're just one trade away. Mwah.